We have with us Vijay Valecha, CIO of Century Financial, to answer all of these questions and even more. Welcome with us, Vijay. Let us start talking about the most important. Goldman Sachs and Morgan Stanley reduced their expectations for the oil prices till the end of the year. Goldman Sachs dropped it by $5. Do you agree with reducing the prices for these two investment banks who have said that it's a matter that's related to the expected weakness in the demand and an increase in the supply?
Yes, absolutely. I agree with most of the things that have been said by the reports, but not all. There is definitely a lack of demand. We actually expected a much better rebound to come in from from China, which hasn't so far. So we are not seeing demand coming in. Although we do have the PMI manufacturing and PMI non-manufacturing data coming out on China on Saturday. But that being said, that data has disappointed so far 8 months in the year. So we don't really expect major surprises on the positive side as well. The demand definitely is reducing for oil, and that's why the price targets for oil at 70 for the end of the year is not very far.
Vijay, also some reports pointed out that today the drop in the production and the stop in the production in Libya will serve the U.S. Oil because the nature of the oil is very similar and we will have higher demand on the USA oil. Do you expect that we will have less price gap between Brent and WTI, or perhaps the effect will be just limited?
We do expect the price between WTI and Brent to narrow down in the rest of the year. Well, actually, when we look at the fraction spread between WTI and Brent, we do look at it as a percentage also, not just in absolute points. So once the base was 100, the spread was supposed to be different. If oil prices actually fall down towards 70 or 65, this spread should be much narrower. It should be more like in the $3 or $4 range. And that's what we expect to happen at the end of the year. However, that being said, the US oil will not be of much importance if oil prices actually do fall to those levels. The WTI and Brent spread will just reduce on natural percentage reduction. It won't be a function of US oil being a substitute for Libya oil. But yes, we are seeing geopolitical tensions around, so I don't think this is actually a very temporary problem which we are seeing with the Libyan oil fields.
Vijay, in which scenario you expect that we will start having a better refinery margins, specifically for the Asian markets?
Well, we expect that to actually come in when China demand picks up. That is actually expected not in this year, but starting from next year. A turnaround in the China economy story is what we actually expect to happen next year, and that's where we actually see the turnaround coming in.
In case we have this recovery in the Chinese economy, Vijay, will this serve the gold, or will negatively impact the gold, specifically that the individuals in China are buying the gold because they fear what's happening in the real estate sector there?
I feel that inflation has not hit Asia as hard as it has hit actually Europe and the American continents. That inflation adjustment is coming to Asia now. So that effect will be actually seen next year at a very heavy level. That's where the gold buying will actually happen to counter inflation itself. I see gold demand in China and rest of Asia to continue increasing next year rather than reducing, even if the economy does pick up.
Vijay Valecha, CIO at Century Financial, thank you so much for being with us.
Thank you.
Always a pleasure. Bye-bye.
Thanks. Bye.